The Federal Reserve System works every day to support a growing and stable U.S. economy. Across the United States, the Federal Reserve, through its Federal Reserve Education Program, also helps people understand how the economy works, so consumers have the tools to make sound financial decisions. Through this education program, teachers have access to classroom-ready online resources for students from kindergarten to college, videos, classroom lessons, online education, publications, and more. These resources are all free for educators to use in their lesson plans, or as they see fit. Many of the Federal Reserve System's regional reserve banks, located in 12 districts across the nation, also offer in-person and online professional development that allows educators to deepen their knowledge and hone their craft when it comes to economics, personal finance, and more. Students, too, can take advantage of in-person opportunities by taking tours of exhibits in many of the 12 Federal Reserve banks around the country. Whether a student visits with their family or a school group, they get an in-depth look at how the Federal Reserve works to promote a healthy, sustainable U.S. economy. At the Board and Reserve banks, students also get hands-on opportunities like internships and participation on student boards, which introduce them to key economics concepts and potential careers in economics and finance. Consumers are empowered to make sound financial decisions through the availability of easy-to-understand resources that explain personal finance concepts, the broader economy, and the Federal Reserve's role in it. Federal Reserve Education is committed to equipping educators, educating students, and empowering consumers when it comes to understanding and participating in our evolving economy. For more information, visit federalreserveeducation.org to find links to resources and Reserve Bank programs offered near you, and follow Federal Reserve Education on Twitter at @FedEconEd.
What is the Fed?
So what is the Fed?
What is the Fed?
What is the Fed?
The Federal Reserve, often referred to as the Fed, is the central bank of the United States.
Congress created the Fed in 1913 to help promote a safe and sound monetary and financial system for our nation.
The Fed includes the Board of Governors in Washington, D.C., which has 7 members, including the chairman and vice chairman.
All of the members of the board are appointed by the President of the United States and confirmed by the United States Senate.
The Fed also includes 12 regional Federal Reserve banks located in cities throughout the country.
The reserve banks serve as the central bank's operating arms and also gather economic information from all over the country
to help the Fed both monitor the economy and get the broad input necessary
to develop and implement effective U.S. monetary policy.
Today, the Fed performs a number of important functions, all with the ultimate goal of promoting a healthy U.S. economy.
One of the Fed's most recognizable functions is conducting U.S. monetary policy,
which involves influencing interest rates and the availability of money and credit in our economy.
Congress has tasked the Fed with implementing monetary policies that promote maximum employment and stable prices.
High levels of employment provide people with more economic opportunities, and stable prices promote growth
by making it easier for households and businesses to plan for the future.
Monetary policy decisions at the Fed are made by the Federal Open Market Committee,
which includes all 7 members of the Board of Governors and presidents from the reserve banks.
This committee meets regularly to assess the conditions and outlook for the economy.
In addition to conducting monetary policy, the Federal Reserve also helps to supervise and regulate the nation's banks and works to promote a stable financial system for consumers, communities, and businesses.
The Fed also works with communities, nonprofit organizations, and others across the nation to address housing problems, promote equal access to credit, and advance economic and community development.
The Fed also promotes stability in the financial system, because instability in the financial system can pose a severe threat to the broader economy and to communities across the nation.
The Fed also acts as a bank to other banks by clearing checks, making electronic payments, and providing the currency that Americans need and use every day.
Our nation's economy and financial system face constant challenges.
The Fed is working every day to address those challenges and is committed to helping foster good economic conditions and outcomes. employment opportunities, stable prices, and financial stability that benefit all Americans.
And we are also the Fed.
To learn more about the Federal Reserve, you'll find a wide range of resources on the Board of Governors website at federalreserve.gov.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context of our broader tightening program, if I may, and talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate, and we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time, and we put that into our post-meeting statement because that really does become the important question we think now is how far to go, and I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last 2 press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last 2 meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember, though, that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick Tamarosa, the Wall Street Journal. Chair Powell, core BCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high 4s, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many, many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, people who publish an assessment of underlying inflation.
Thank you.
Hi,
Hi, Chair Powell. Thank you for taking our questions. Gina Smilik, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So, I guess I would start by pointing to expectations. So if we saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter-term inflation expectations moved up between the last meeting and this meeting, and we don't think those are as indicative, but they may be important in the wage-setting process. There's a school of thought that believes that. So that's very concerning. I guess the other thing I would say is that the longer we have, we're now 18 months into this episode of high inflation, and we don't have, a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so, the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking what is the central bank going to do. And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy, whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this, it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't, of course, we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting, a new summary of economic projections which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Thanks, Chair Powell. Neil Irwin with Axios. As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of labor market, consumer demand, a lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. Sorry, was I getting to your question there? Housing, the housing part of it. Yeah, so, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So it's a very different situation and doesn't appear to present financial stability issues. But no, we do understand that's really where a very big effect of our policies is.
Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers, and I'm just curious to what extent you do and don't draw a signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line. But so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, a very small increase this year, which we thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see, so I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside that if you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So That's the picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening. And maybe that's there, but it's not. It's not obvious to me because wages aren't coming down; they're just moving sideways at an elevated level, both ECI and average hourly earnings. We want to see. We would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought the data series is volatile. We never take any one reading. We always look at 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation, and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that. That'll be discovered empirically.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the U.S. that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine, and we're seeing China's having issues with the zero COVID policy and much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but we have we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis, and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully. Even though it may be difficult to get it back, getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. the thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer-term inflation expectations anchored, and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Hi, Chair Powell, Janelle Marte with Bloomberg. So the Fed is facing 2 more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming common?
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of the policymakers violates or falls short of those rules, we do risk undermining that trust. And we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. We've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that the problems with President Bostic's disclosures were discovered when he filed his new disclosures. That's, we now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures, and also all of their trades. Any trade anyone has to make who's covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens, so there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we recommitted to each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Do you have an update on the investigations that are pending?
I don't. So, as you know, I referred the matter concerning President Bostic to the Inspector General. And once that happens, I don't discuss it with the Inspector General or with anybody. It's just the Inspector General has the ability to do investigations. We don't really have that. So that's what he's doing.
Michael McKee from Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve with 100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. That curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over-tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term forward spread. You're right, and that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted, and also you have to look at why why the rate curve is doing what it's doing. It can be doing that because it expects cuts, or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So yes, we monitor it. You're right, and that's what I would say.
If I could follow up, you also said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that risk assessment has changed a little bit?
Well, what's happened is time has passed and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over tighten, and we don't want to, we want to get this exactly right. But if we over tighten, then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road and you're realizing inflation behaving the way it can, you're realizing that you didn't actually get it, you have to go back in. By then, the risk really is that it has become entrenched in people's thinking, and the record is that the employment costs, the cost to the people that we don't want to hurt, they go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now, and I think as we're farther along, we're now focused on that. What's the level we need to get to rates, and I don't know what we'll do when we get there. By the way, we'll have to see. There's been no decision or discussion around exactly what steps we would take at that point, but the first thing is to find your way there.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up, as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lagging government indicators?
So this is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents. The private measures are of course good at picking up the at the margin the new leases, and they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as non-new leases roll over and become and expire, right? There's still in the pipeline, there's still some significant rate increases coming, okay? But at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Great. And just a quick follow. It looks like stock and bond markets are reacting positively to your announcement so far. Is that something you wanted to see? Is that a problem, or how that might affect your future policy to see this positive reaction?
We're not targeting any one or two particular things. Our message should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher, and that's been the pattern. I mean, I would have little confidence that the forecast if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another, they go up, and, that'll end when it ends, but there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So I control those messages, and that's my job.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
In theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. So I think those two things do tend to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, people are, the banks that deal with retail customers, and many retailers will tell you that the consumers are still buying, and they're still, they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
It's demand is going to have some support from those savings, and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects, although I think overall I would say it's not really tightening or loosening. So we see those things, and what those things tell us is that our job is going to require some resolve and some patience over time. We're going to have to stick with this. That's just we take all that as a given, but we know what our objective is, and we know what our tools can do, and that's how we think about it.
Hi, Chair Powell. Nancy Marshall-Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path has narrowed over the course of the last year, really. Hard to say. Again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to. Ordinarily, there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data's a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. Again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
But just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves. We would have expected goods inflation to come down by now, long since by now, and it really hasn't. Although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
Why do so many large programs across the West not work? It's because there's a multi-billion
that in actuality, that would be the third negative GDP quarter if you backed out exports, with earnings coming in slightly lower than expected. So these things are working on a lag basis, and the fact that he kept that downshift on the table, I think, is that drink of water in the desert, Dave.
Well, Tom, what if we don't see that downshift, though? Because there's already been criticism out there that the Fed has been way too hawkish up until this point. This was the fourth 75 basis point hike in a row. Powell did say he doesn't have a sense that the Fed has over-tightened or that they have moved too fast. Are you at all concerned that they have been too aggressive up until this point?
I do think when all is said and done, they'll find that they've been too aggressive and they'll have to pivot and actually start to cut sometime in 2023. As we've seen throughout history, it's always the case that they over-tighten. The question is how much they're going to look through the rearview mirror and how much they're going to look through the windshield. And right now, they're solely looking through the rearview mirror. And the reason the market initially rallied was that they said, okay, we will take into effect the lag basis, but then they discounted it completely. So I think when you look at the seasonality of the market, look, if the data comes in strong, it means the economy's strong. The market here at a multiple of 16.3 versus the 18.5 for the last 10 years, a lot of this bad news is priced in. You know, the NASDAQ down 30%, S&P still down 18%. We have priced in a decent-sized recession at this point, but stock selection and sector selection is going to be critical. You can't just say wholesale, all in, risk on. You really have to look case by case moving forward.
Okay, RJ Gallo made the same reference. Look through the windshield and not the rearview mirror. Yeah. Fine, you look through the windshield and tell me how they can even begin to consider pausing.
Yeah, well,
based on what data?
Well, I think first and foremost, you look at commodities. They've completely rolled over since June, so that's going to be felt in the economy. You do see the GDP numbers. Basically, if you net out exports, you're looking at 3 consecutive quarters of negative GDP growth. That's material. You look at earnings coming in lower than expected. You back out energy, you got negative earnings growth year on year. So this is only going to accelerate. So what we would be nice is to see some back off in the CPI numbers, some of the inflation prints between now and December to give them cover. They really need cover. They can't say we're going to predict that the CPI numbers are going to come down in 6 months, therefore we're going to pause. Give them something to hang their hat on, whether, you know, it doesn't appear that it's going to be the jobs report on Friday after the JOLTS, but we've got 4 major prints between now and December, and maybe they don't downshift in December, and maybe it is the meeting afterwards, but he did effectively toggle and say, if not December, then the meeting thereafter, in which case people can start to see the light at the end of the tunnel, and the terminal rate, maybe it's not 4.6, maybe it's 5. But so long as inflation expectations, the 5-year break-even stay anchored at 2.6, I think they'll be able to downshift sooner than everyone thinks, and certainly in the first quarter of next year.
As we've been talking here, the losses accelerating, Dow now off 351 points, NASDAQ off nearly 3%. All right, Tom Hayes, thanks so much for joining us in studio.
Thanks for having me.
Michelle?
All right, well, let's break down some of the biggest takeaways from the Fed's press conference today with Yahoo Finance's Jen Schoenberger, who was attending there. So, Jen, what were your big takeaways?
Good afternoon, Rochelle. Fed Chair Powell laying the groundwork to begin slowing down the pace of rate hikes, though he says he believes rates now need to move higher than previously forecast. He says the Fed is going to start talking about potentially slowing the pace of rate hikes at the next couple of meetings, and will have a discussion with other Fed officials at the start of next meeting. Take a listen to the chairman.
I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last 2 press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restricted, which really will be our principal focus.
And you heard Fed Chair Powell saying that the pace of moderating rate hikes isn't as important as how high they could ultimately take the Fed funds rate. He says the job is not done on inflation. In fact, inflation hasn't come down, and it's pretty much where we were a year ago. He says it's premature to begin thinking about or talking about pausing rate hikes, and that we still need to get to a sufficiently restrictive level on rate hikes. So he doesn't also think that we have over-tightened, or that the Fed has over-tightened at this juncture. And again, the Fed raising rates by 0.75 percentage point this afternoon to a new range of 3.75 to 4%. So Fed Chair Powell standing hawkish at this juncture. Back to you.
Certainly sounds hawkish, and that certainly seems like what the markets believe at this point with the losses that we're seeing across the board. The S&P off just around 2% right now. Jen, what stuck out to me was some of the commentary that he made on the labor market, once again reiterating that the labor market is extremely strong at this point, that demand far exceeds supply. And then also consumer spending. When you said consumer spending showing modest growth, fiscal headwinds haven't really restrained spending up until this point, and all that points to a more hawkish Fed in the future.
Yeah, I mean, certainly the Fed chair believes that the job market does remain strong. Pointed to a number of levels there, notably that the unemployment rate remains low, job gains continue. You saw the JOLTS data. And so that really gives the Fed more room to raise rates without causing a deep recession. And he says that he and the other Fed officials are hopeful that cooling the labor market will not mean that we ultimately have layoffs, but more just fewer job openings in those sorts of junctures to try to bring down the level of tightness, as opposed to an outright layoffs that would be akin to what you would have during a recession.
Certainly a ways to go with unemployment rate at a 50-year low. All right, Jen Schomburger, great job. Thanks so much. Well, there's plenty to come here on Yahoo Finance Live. After the break, investors have more direct access to treasuries, but find out what strategy you should employ following today's Fed decision. The CEO of Dine Brands tells us how Applebee's and IHOP are succeeding despite recession fears. And earnings from Etsy, Qualcomm, Robinhood, and Roku are all on tap. We'll bring you the numbers as soon as they break. Don't go anywhere. Federal Reserve announcing another 75 basis point rate hike today. But what does this hike mean for investors and their bond portfolios? Joining us now to discuss is Alex Morris, FM Investments President and Chief Investment Officer. He joins us as part of our weekly ETF report brought to you by Invesco QQQ. So Alex, when you take a look at the reaction that we're seeing play out in the bond markets, yields on the 10-year Treasury moving to the upside once again right now at 4.10. What's your takeaway, I guess, from what we just heard from Powell and what this means here for investors?
Well, I think the chairman makes a good point. None of us have a crystal ball. I read the statement before coming here, and everything looked fine until the press release happens. And I think it's pretty clear rates are going higher, and they're going to stay there for a while longer. And long term, I think the Fed is making clear they will get a handle on things. So things will come back to normal. It's just going to take a while. And that's more or less what we should expect. These things don't happen on a dime, and when they do, we all get very nervous and overly excited.
So then, Alex, for retail investors who are wondering how they should be approaching treasuries right now, talk about the ETF and some of the ways that they can get into this, perhaps if they're a little bit risk averse.
Sure. So first of all, we built the ETFs because investing in treasuries is a tried and true strategy, but yet remains stubbornly difficult for most investors, retail advisors and otherwise. They trade in fractions, they have messy cash flows. They're not as simple to trade as stocks for a variety of reasons. And we built these single security, single treasury ETFs to make that much easier. You know, folks start looking at the yield curve and they start looking at all the various issues, and it becomes very complicated very quickly. So as you start to look at how do you want to approach this, you know, you want something as security of a treasury, but you don't want to make a mistake in how you invest in it. So we built access to the most liquid, most straightforward treasuries today, which are the on the runs. Folks who are really looking for short-term havens really should look at something on the shorter end of the curve, which is for us the 90-day product. And those who want to take a much longer-term view on the economy and where the Fed will ultimately land things should look towards the farther end of the curve, which for us is in the 10-year product.
So when you take a look at demand right now for these funds, what we're seeing playing out, given the fact that it is such an uncertain environment, I guess if people are second guessing what they should be doing when it comes to investing in treasuries, what's one or two things you would advise them to take into consideration?
The first thing we tell everyone is this too shall pass, right? So not to fall off an long-term asset allocation or long-term game plan. You know, timing the market never really works terribly well. But if you're more worried about short-term movements, stay on the shorter end of the curve, you know, continue to remain invested, but don't think this is the opportunity to try to outrun the market. You won't be successful, and if you do, it'll probably catch up to you pretty quickly.
And Alex, you said that treasuries are, quote, finally interesting again. Talk about this period that way and give us some context given how we've historically seen the market move.
Sure. So for the last little pre-2008, treasuries had a long history of being somewhat elevated. Then all of a sudden we entered a decade of zero interest rates, which is something that hadn't really been seen or thought of before. And many investors have come up and gotten used to, you know, relatively low-cost capital that can fuel all sorts of things in the bond market in new and interesting ways, as well as the equity markets, which we certainly saw in the past decade. Now as rates go up, and we look backwards, you know, 20 years ago, rates were higher than this, and certainly in the 80s, substantially higher. So now as we move rates up to try to destroy some demand, as Chairman Powell made very clear, now we have to decide how do we get access to yield as well as have some negative correlation, at least historically, to the equity markets. Traditionally, that's been treasuries. Certainly credit spreads have started to widen, but haven't cracked yet, which is still a good sign for the bond market. But for those who have been risk on and now are looking for a safe haven, treasuries have traditionally been that location to go to, and we built products to make that easy to access.
Access certainly important, especially for retail investors trying to get a handle on all these movements. Alex Morris, thank you so much for joining us this afternoon. All right, coming up, Paramount is generating a lot of buzz on Wall Street today, but that's not a good thing. We'll tell you why shares are falling next.
Simplify, helping advisors build better portfolios. HEQT, Simplify Hedged Equity ETF. It's the oldest rule in the book on investing. Buy low and sell high. Understandably then, if equity valuations continue their meteoric rise, more investors may find it challenging to stay the course with their equity portfolios. Additionally, managing the risk of balanced portfolios with bonds has been increasingly difficult given today's low yields and the possibility of rate hikes. That's where Simplify comes in. Simplify's hedged equity ETF seeks to address these issues by creating a fund that provides meaningful equity market participation while aiming for a smoother, lower volatility ride. So how does it work? HEQT starts by investing in a low-cost, passive ETF that tracks a large-cap U.S. equity index. It then invests in a series of put spread collars designed to help lower the volatility. And by using a ladder of 3 monthly collars, rather than just a single quarterly collar, the fund seeks to minimize any unwanted rebalancing luck within the option overlay. Where does HEQT fit in portfolios? Since the fund is designed to be a core equity investment aimed at lower volatility, it can be used to help trim equity risk while still staying invested. Additionally, given the reduced volatility profile, the fund can also be used
Now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Fed Chair Jay Powell also saying it's premature to talk about pausing the rate hikes here. We're seeing that reflected in the markets this afternoon with just about 18 minutes to go until the closing bell. You're looking at the Dow off 348 points. NASDAQ, the worst performer of the three major averages, off just around 2.7%. Jared Blickery has a closer look at the big board of some of the selling that we're seeing as a result of what we just heard from Powell.
That's right. Let's go through some of the market movements here. I think it's instructive to view what happened first and then what happened next. At 2 p.m., we got a bullish tilt to the markets, and that's based on expectations that the Fed might eventually, pare back the blistering pace of rate hikes. But Powell put a quick end to that early on in the presser. And you got to think that the Fed is actually doing its job here. The Fed doesn't want to see stocks higher on a day when it's contemplating or at least signaling that it might back off the rate of rate hikes here. And that's what we're getting. So the S&P 500 down 2%. I'm going to go through some other markets here. Volatility is up. You can see the VIX. The VIX is actually net down from that time period. And so that's pretty interesting. Going to make a note of that. 5-year T-note yield did drop on that announcement, and then it basically came back to the entry point, and then the 10-year T-note, it's actually higher based on the 2 p.m. print that we got. Finally, here's the 13-week T-bill rate that tracks closely what the Fed's short-term, the Fed funds market is doing right now. Now, the U.S. dollar index ended higher as well, so all of this is signaling that there might be some more risk aversion in the markets, although we're getting a conflicting picture here between yields and the dollar. I think we're going to see that sorted out over the next 24 hours. Also want to show you what's happening in Bitcoin, because this would be the supreme irony if Bitcoin actually led the way. Didn't fully participate to the upside, wasn't as up as much as some of the equities, and now it is given those back. So Bitcoin foretelling the future that maybe we have to wait a few more announcements before we're going to get that final pivot that everybody's been expecting. That would be some irony right there. Let me just close with some of the sector action and some heat maps that we're looking at. Everything in the red right now. I was talking about the hit that we were taking to yields. Normally that would benefit some of the mega caps, but not today. We're seeing consumer discretionary, tech, and also communication services down more than 2%. So again, it's probably too early to parse out what these movements quite mean. Going to take another day or so, but in the meantime, stocks are down. Maybe Chair Powell did his job.
I guess so. Even energy down 2.2%. Wow, yeah. Good stuff. Jared Blickery, appreciate that. All right, Fed Chair Jerome Powell addressing the state of the housing market in the wake of today's interest rate hike.
The housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. You know, from a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very carefully, much more carefully managed by the lenders. So it's a very different situation and doesn't present doesn't appear to present financial stability issues.
Rising mortgage rates have soured housing demand recently, but there is some good news, a glimmer today, if you will, with the 30-year fixed falling a bit to 7.06% from 7.16% a week ago. That's according to the Mortgage Bankers Association. Now, rates are still near 2-decade highs, and we also saw applications decreasing for the 6th straight week. And now, lenders and other companies in the industry are reeling amid the broader slowdown. CNBC reporting Wells Fargo was processing about 18,000 retail loans early in the quarter, down almost 90% from a year earlier. And mortgage staff at the bank are bracing for layoffs. It's not just the big lenders. Opendoor, a home flipping company, announcing layoffs of 18% of its employees. That amounts to roughly 550 people. And the stock is down 4.5% on the news and extending losses in the wake of the Fed decision. And look, when we bake in the 75-point hike and the fact that it is, again, premature to think about pausing, you got to factor 30-year fixed driving up at least a quarter of a point. They're going to continue to go up, and the housing market will continue to slow. And Rochelle, that probably is going to cost thousands of jobs in the mortgage industry.
I mean, and you referenced that CNBC article. Obviously, when you have this slowdown, think of where we were during the pandemic-fueled boom in the housing market. It was just a matter of time when you now see the downside of that. You're also seeing the higher mortgage rates. And so they're obviously far off their peak. And we know that they began cutting workers in April, Wells Fargo did. And so a lot of people, some of the sources mentioned in the article there, saying that some of these, though, have been a mix of some voluntary bankers sort of seeing the writing on the wall and moving on to other positions. So kind of clouding the picture as to how much of this has been voluntary versus how much of these layoffs had to be done. Now, we know that last month, CFO Mike Santomassimo told analysts that we expect it to remain challenging in the near term. It's possible we have a further decline in mortgage banking revenue in the Q4 when originations are seasonally slower. So certainly bad timing on top of everything else. But obviously a very tough time there, and a lot of people at Wells Fargo concerned about job security, Shauna.
Yeah, and I don't think this comes as a huge surprise given the massive slowdown that we've seen in the industry. We've been talking to a number of guests about what we are seeing play out in the mortgage industry specifically, and how challenging it's likely going to be over the coming quarters, given the fact, what we just heard from Jay Powell today, that he is going to remain hawkish. Or it's still premature to talk about pausing rates or even any sort of pivot. So certainly it's going to be a tough time ahead. There was a recent data out from Black Knight saying that just 133,000 U.S. homeowners at this point can save money by refinancing at today's rates. And that's down, Dave, from a peak of over 19 million in late 2020. So really that really just illustrates how dramatically this industry has changed over the last year and a half or 2 years, from the peak of the pandemic to this, I don't want to call it a bust. That almost seems a little bit too aggressive at this point, but a significant slowing that we are seeing play out in the mortgage industry and layoffs as a result.
And Powell said they're looking for some softening in the labor market. If they're looking really hard, they should look at the mortgage industry. That's where you'll see the beginning of some cracks in the labor market. Coming up, Electronic Arts voicing optimism following its latest earnings, much of it having to do with one of the company's most popular video game franchises. Stay tuned.
This is Wix.
ETHEREUM represent. Yeah. 205, Papero, 826.
Yo quiero tenerte, pero no tengo la suerte.
¿Cómo así?
Todo sube, nada baja, nadie suelta una rebaja. Mi cartera es un desierto, pa' pagarme lo que quiero.
time for Triple Play, the 3 stocks that we're watching in the last 10 minutes of trading. We've got MoneyGram, Paramount, and Electronic Arts on deck. Now, my pick is person-to-person payment service MoneyGram, the company debuting a feature allowing U.S. consumers to trade and store Bitcoin, Ethereum, and Litecoin via its mobile app. Now, the company joins others attempting to bring real-world cryptocurrency and blockchain use cases to life for everyday consumers. In a statement, Alex Holmes, MoneyGram's chairman and CEO, said, "Cryptocurrencies are additive to everything we're doing at MoneyGram. MoneyGram enables instant access to over 120 currencies around the globe, and we see crypto and digital currencies as another input and output option." Now, this isn't MoneyGram's first foray into crypto, but it's moving more conservatively this time, with just a few more established crypto tokens. Its previous partnership with Ripple came to an end last May after Ripple got sued by the SEC in December of 2020. Of course, Coinbase recently joined a number of groups in arguing that the SEC's case threatens the broader industry. So still a lot of volatility to be had here, but MoneyGram, though, still pressing ahead here, Sean.
They're pressing ahead. It's not doing a lot for the stock today, though. When you take a look at the market, the reaction, although obviously there's a bigger macro picture going on in today's market action, but certainly if you take a look at the stock, down just a fraction here, so not a lot of excitement. I think potentially MoneyGram's move here, you could make the argument that it could maybe be a step forward into making Bitcoin cryptocurrency, taking that mainstream, giving access to more and more users in terms of that. There was a recent Deloitte survey saying that there certainly is appetite out there for users to be able to get access to cryptocurrencies and use that as part of their transactions. 3/4 of retailers plan to accept either cryptocurrency or stablecoin payments within the next 2 years. 3/4, 75%. That number stuck out to me because I thought it was a bit high when you think about how many transactions are actually done with Bitcoin or other cryptocurrencies today. All right, my pick today is Paramount. It's a top trending ticker on Yahoo Finance. Look at that, losses of just over 12%. Shares are sinking after revenue missed Wall Street estimates. A number of headwinds facing the company, including the rise of cord cutting and a slowdown in the advertising market. Now, sales from its TV media segment falling 5% from the previous quarter to $4.9 billion, and advertising revenue dropping 3% to $1.9 billion. Paramount Plus was a highlight for the quarter, though. 4.6 million new subscribers were added. That was actually better than what the street was looking for, what many analysts were anticipating, bringing its total to 46 million customers. Dave, comparing that to its larger competitors, obviously just a fraction of subscribers, but they are headed in the right direction.
They are. Variety, though, reporting some layoffs coming as they consolidate with Showtime. Some positives coming to Paramount Plus. You've got Top Gun and Smile coming to the format by the end of the year. And, of course, that Walmart Plus subscription half price. That includes a free Paramount Plus subscription, so some catalysts there. My play is EA, Electronic Arts, shares up on its latest earnings report. Despite a post-pandemic pullback in gaming and currency headwinds, EA did beat on revenue and EPS. The company touting a record-breaking launch of FIFA 23 with over 10.3 million players within the first week, signaling the biggest launch period ever in EA Sports FIFA franchise history. They added this year's title has been played in more than 200 nations worldwide. The CEO, Andrew Wilson, saying the entire global football community across our ecosystem will benefit from the unique holiday timing of the World Cup, and that's because of the change of the schedule because of the heat in Qatar. It's now just 18 days away, by the way. They did lower their annual bookings forecast to between 7.65 and 7.85 billion from 7.9 to 8.1 billion. Overall, the gaming market is expected to grow just 2% in 2022, so you're really seeing some shrinking there. Earlier this week, EA also announced a 3-game deal with Marvel, which will start with an Iron Man game. The stock up just about 2%, was up much higher, but like the rest of the market, pulled back a bit, down about 4% year to date, Rochelle.
I mean, I will say you couldn't have asked for better timing if you partnered EA, FIFA, and the World Cup. You want to talk about a match made in heaven? I'm super excited for the World Cup. You will hear me talking about it constantly. So yes, a boon there, obviously. Someone even on Twitter challenged me to a FIFA match. Well, I was like, I don't even play the game. Why am I even in this? But
oh, you don't play?
I gotta try. I don't even play, but I might just out of spite.
All right. I'm very excited for the World Cup too, getting underway very, very soon. All right, well, coming up next, we are counting down to the closing bell on Wall Street. We'll be right back.
All right, just a few minutes away from the closing bell on this Wednesday Fed day. Jared Blicker here to break down the market action. What are we seeing, sir?
A lot of red, so maybe the Fed is doing its job if it doesn't like to see green markets on Fed day. Who's to say? NASDAQ down over 3%, so is the Russell 2000. I'm going to show you inside the NASDAQ 100. Mega caps really taking it on the chin here. Apple down more than 3%, so is Microsoft, Alphabet, Tesla down 5%, Amazon 4%, Meta 4%, Costco 3%, and the list goes on. And let's take a look at the sector action to see what's going on. These are the tech-heavy and mega-cap-heavy sectors that we see down here. Utilities, the least dirty shirt in the laundry basket. That's still off 0.9%, followed by financials and healthcare. So all in all, not the best banner day for equities. We'll have to see what happens tomorrow. But here is our leader in sentiment index, not index, but markets. We see KWEB, that's a Chinese internet ETF. You can say divorced from the current day. Other than that, it has been a weak day for a lot of these fringe market. Let's take a look at the travel sector, and we are here for the closing bell.
Stocks ending the day in the red as we wrap up the trading action post Fed Chair Jay Powell's presser there. And look at those losses ending at the lows of the day. The Dow off 506 points, S&P off just around 2.5%. NASDAQ, the biggest laggard here in today's action, off just nearly 3.5%. A lot of those rate-sensitive stocks, many of them tied to the tech sector, leading today's sell-off. And the market's really focused on the fact that Fed Chair Jay Powell saying that it is too premature to think about pausing rates, saying that there is still plenty of ground to cover. Ongoing rate increases seem appropriate at this point. So let's talk about what this means for the markets going forward. For that, we want to bring in Sam Stovall. He's CFRA's research chief investment strategist. And we also have Michael Kushma, Morgan Stanley Investment Management Chief Investment Officer of Broad Markets Fixed Income. Sam, let me start with you. I guess just your reaction to what we heard from Fed Chair Jay Powell and the selling that we saw as a result.
Well, Shawna, I guess I'm not too surprised because the Fed has been telling us for a while that it does not want to make the same mistakes that it did back in the 1970s. It doesn't want to end up pausing or even pivoting before they know that inflation is under control. And we've also seen over the last week several reports, whether it's Q3 GDP, construction spending, or the expectations for Friday's jobs report, that the Fed still is engaged in an uphill battle with inflation.
And Michael, we heard from previous analysts, they commented that the markets were just a little bit too enthusiastic about what they thought they were going to hear from Jay Powell. And as we see from the sell-off that we saw today, that seemed to be the case. What is it that they are missing when it comes to this picture right now?
Well, I think that Jay Powell said something along these lines in his press conference today. There's three elements to monetary policy: how fast, how high, how long. And we hadn't even gotten to the concluding how fast they were going to go. Only today did he really start talking about, yes, at some point we're talking about slowing down. So not even yet finished with phase one, which then is, well, how high do we have to go? So they're not even clear about how high they have to go. And then they're certainly not clear how long they will have to stay. I did think the emphasis on not wanting to, they want to take into account the long lags on monetary policy does suggest at some point they will slow down because the monetary tightening so far will impact the economy, but it's premature to talk about slowing down yet.
So to Michael's point, Sam, how high do you have to go? Do you think we're talking about a Fed funds rate around 5? And do you factor in hikes through March?
Yeah, Jared, I think we're going to see the Fed funds rate right now. Our target is between 5 and 5.25, and that number itself is suspect to being raised over the coming months. Our belief is that the Fed will raise rates by 75 basis points in December, and then we'll engage in another 50 basis points in the February timeframe. So the Fed's not done yet, and I think it's going to be in the 5s before we hit a terminal rate.
Sam, what about the risk then of the Fed going way too far? I know Powell saying at least up until this point, he doesn't think that they've made the mistake of tightening too much. But if in fact we do see another 75 followed by another 50, where does that put us?
Well, I think that even from the very start, at least a mild recession was something that investors had to anticipate. Any time that the year-on-year percent change in headline CPI exceeded 6% going back to the late 1940s, we ended up with a bear market and a recession. That bear market ended up being deeper and lasting longer than average bear markets without recession. So just the fact that the Fed was already 750 basis points behind the curve, meaning that normally Fed funds rate is higher than that year-on-year CPI number at the start of rate tightening programs, but this time around things were reversed by that 750 basis points.
So, Michael, by erring on the more hawkish side with these comments, how should investors be thinking about this period between now and the next Fed meeting?
Well, I think it's as the Fed has said multiple times, they've given up on forward guidance. The world is too uncertain. We don't know what's going to happen, so it's very data dependent. We'll have to see the flow of data. However, in order to be more confident about the disinflationary trajectory, they'll have to see multiple months of improvement. Between now and December, you don't have a lot of time. So even if we get a better inflation print this month and early December before the next Fed meeting, it might well not be enough. It may be enough to keep them at 50, but to go less than it, I think it's not feasible at all. So 50 is sort of the minimum next month. But going forward in 2023, it does become extremely data dependent. And right now, the momentum in the U.S. economy is a bit on the upswing, and job growth is slowing, but at a fairly slow pace, such that the unemployment rate is likely to stay low. So again, the danger, if they prematurely slow the pace of tightening and then move maybe to easing too soon, the economy will just reaccelerate again, and they'll be in a worse position at the end of next year.
That's a good point. And Sam, circling back to your 75 and 50, how do you invest into those conditions?
Well, I think you have to continue investing from a defensive perspective. Looking at my momentum model, basically it is the old standby of staples, healthcare, utilities, and also to energy. And whereas you want to be avoiding those groups that tend to get hurt the most by rising rates, which would be your growth areas, communication services, technology, real estate. So right now it's, playing it close to the vest with defensive sectors is probably the best way to go.
Sam Stovall and Michael Kushma there. Thank you so much for joining us on this Fed Day with your market breakdown. Dave?
Thanks, Michelle. An earnings alert here. Qualcomm has now reported. Dan Halley is here to break down the numbers. You can see shares moving to the downside about 7% after hours. Dan, what are we seeing?
Yeah, so they met expectations on revenue. They came in at 11.39. The expected was 11.4. So you can, kind of round up there, and they're meeting it. But as far as adjusted EPS, they missed. They came in at $3.11 versus expectations of $3.13. But the big deal here is for the next quarter, their Q1. They have expectations for adjusted EPS of $2.25 to $2.45. The expectation, though, from Wall Street was for them to announce $3.40. That's a big difference. So that's why we're starting to see, or potentially why we're starting to see, that stock price start to slip now, down around 5%. And part of that has to do with the smartphone market and how we're seeing weakness there as far as people not necessarily needing or wanting to go out and buy smartphones, making these big kind of pricey purchases when the economy is, we're hearing so much about a potential recession. And I think that seeps down to the average consumer. And so they kind of pull back on that kind of spending, especially on something like a smartphone where, look, if the one in your pocket works, you don't necessarily need a new one. It's more of a luxury buy when you don't have those kinds of issues. So I do think that that's probably something that we're going to continue to talk about. Obviously, Apple had a lighter quarter than expected for their iPhone sales. So that's a pretty good indicator of how the rest of the industry is doing, especially since, it's Apple.
Hopefully we get a read on if that Apple relationship is going to continue longer than we originally thought, which could certainly help. Dan Halley, thank you. Good stuff there with Qualcomm earnings. All right, Roku has now released its third quarter earnings after the bell. Yahoo Finance's Ali Canal has those numbers for us. And look at that stock, Ali, down 20% after hours.
It's pretty stunning, and it was an interesting story after the market closed, after we got these earnings, because it surged and then it came way down. So let's break down what investors initially reacted to. We had a beat on revenue, 761.4 million versus the expected 702.35 million. Also a narrower adjusted loss per share of 88 cents versus the expected $1.22. So a beat there on both the top and bottom lines. Also a beat on active account growth. But here's the bad news, and that's what's driving down the stock by more than 20%. It's their guidance. The company now sees fourth quarter adjusted EBITDA loss at about 135 million versus the expected loss of 45.5 million. So that's a huge discrepancy that Wall Street is reacting to. Net revenue guidance for the fourth quarter also lower, 800 million versus 897 million expected. And we're just getting news as well that Roku CFO Steve Loudon plans to leave the company in 2023. So this is just a lot of information for investors to digest. In the earnings release, the company said, quote, "As we enter the holiday season, we expect the macro environment to further pressure consumer discretionary spend and degrade advertising budgets." Now, advertising is what's been talked about with a lot of these tech companies, especially following the results of Meta, Snap, Alphabet. The state of digital advertising largely in question amid a lot of these macroeconomic challenges. So a lot of near-term headwinds for this company. They have been spending pretty aggressively. They did say they were going to cut back on headcount, but right now investors not too happy there, with shares down more than 20% in after hours.
Quite the sell-off indeed. A big thank you there to our very own Ali Canal. All right, well, stay with us. Coming up, we're taking a closer look at Qualcomm's earnings. The stock sliding on that weak guidance. As you can see, they're off more than 6%. Stay with us.
Let's take a look at Robinhood. Their earnings report just released. You can see shares up just around 2.7% and beat on both the top and bottom lines here for Robinhood. Sales coming in $361 million. The estimate was for $355.2 million, a narrower loss than expected, as well a loss of 20 cents. The estimate out there was for a loss of as much as 31 cents. Transaction-based revenue coming in at 208 million. That was short of what the street was expecting, though. Crypto revenue also coming in a bit light there, 51 million. Estimate out there was for 56 million. Monthly active users totaling 12.2 million. That was a bit lighter than what the street was hoping to see at 13.7 million. Average revenue per user coming in at $63. Estimate out there was for 62.58. So a better reading on there than what we had initially anticipated from the street. But the beats on both the top and bottom line, specifically what we're seeing in revenue, 361 million, better than what the street was looking for at 358 million. That's a big reason why shares are up just over 2% in after-hours trading. Rochelle?
Meanwhile, a different story for Qualcomm, moving downwards there. You see they're more than 7%. That's after reporting fourth quarter results. We have Christopher Rowland joining us, Susquehanna International Group Senior Equity Analyst, to really break this down for us. So as you dive into this earnings report here, what was it that you think was really the problem?
Yeah, there are a confluence of headwinds that they're now experiencing. So they, at the same time as seeing a rapid deterioration in demand, they've also seen supply constraints ease for most of their competitors. So this has resulted in elevated channel inventories that are now going to take multiple quarters to fully get through.
How'd the guidance look?
The guidance was dreadful, truthfully. So we're looking at about 9.6 billion versus estimates of 12 billion. So this is probably the worst Qualcomm guide I remember in multiple years here. They also lowered their overall outlook for total handset volumes from, they were previously at mid-single-digit declines. They're now at low double-digit declines for the calendar year. So pretty dreadful.
Chris, going into this earnings report, you had 165 price target and neutral rating on the stock. You said that this was the worst guidance that we had seen in quite some time. So what does that mean for just in terms of what we could potentially see over the coming quarters? And are you changing your rating because of this?
Yeah, our rating right now is neutral. We downgraded shares last year on a bigger, broader semis downgrade for the entire industry because we were worried about this. We were worried about over shipping. For Qualcomm, this is a fantastic company that is reinventing themselves. We're going to take a fresh look at this after we have this reset overall. But Qualcomm over the next few quarters is going to have to work through this inventory. And if we get line of sight into clearance on that inventory side, we would get perhaps more aggressive.
And Christopher, in terms of where you see the growth story coming, in terms of what's going to be driving growth for Qualcomm, especially after this earnings report, where do you see the opportunities?
Yeah, their biggest opportunity is going to be automotive. They recently, this quarter, held an automotive day, and they have some significant opportunities, for example, ADAS and autonomous driving. That will be a very, very big push for them overall as they continue to diversify outside of just handsets. But in handsets, 5G is not done yet globally. India is just starting to ramp 5G, for example. That'll be a new opportunity for them as well. And then they're moving into RF components as well to compete with guys like Skyworks and Qorvo on that side of the handset as well. So we view that as opportunity for them entirely.
This is stock already down 37% year to date. We were expecting or are expecting some news on that relationship with Apple and how long it may be extended. What do you expect there?
Yeah, if you hear anything, let me know. But the expectation right now is that the internal modem development program at Apple is taking longer. They are going to need at least another year here. And so Qualcomm right now is in the catbird seat in terms of negotiations. They will likely be able to negotiate nice prices for their modem and their 5G modem and content into that phone for at least another year. But we'll see where they go from there.
Chris, we're going to get the earnings call underway very shortly. I guess, what's the number one thing you want to hear from management? I know guidance is your big focus here, this large slump that they are expecting to see in terms of the smartphone industry. But what's the number one thing you're hoping to hear?
Yeah, number one is going to be this handset slump that we're in. What inning are we in? How much of the shortfall here was actually true demand versus inventory digestion? How long is this inventory digestion going to take? And when might we get to the other side of it? Is this a 1 or 2 quarter event, or is this going to last well into the second half of next year? These are the things that are important for me.
All right, we're looking forward to hearing you back after that. Christopher Rowland, SIG. Appreciate that, sir. Thank you. Let's have another earnings alert now as shares of Etsy are moving well up, almost 10% on their Q3 earnings. Yahoo Finance's Ali Garfinkel here with the numbers. Ali, what are we seeing?
Great to see you, Dave. So, we're getting some good news out of tech today. Etsy's popping on that gross merch sales beat. It came in at $3 billion as opposed to the expected $2.9 billion. We also saw a revenue beat, Dave. About 600 million as opposed to the 563.6 million expected. We did see a loss per share at 762, and there were slight misses, right, on active buyers, active sellers, but it's that Q4 revenue guidance, Dave. We've seen so many revenue guidance misses for Q4, but Etsy's coming in within the range between 700 and 780 million as opposed to the expected 744.6 million. So good news out of Etsy today. We'll see if they can keep it up.
Yeah, you talk about another company that desperately needed that good news, been beat down 58% year to date, but up double figures now on that news. Great stuff, Ali Garfinkel. Appreciate that. Coming up right here, shares of Roku have slid by roughly 75% year to date. See what Wall Street expects from the streaming platform for the rest of the year. Next.
Amid a broader market sell-off, Dine Brands ending the day modestly higher after reporting better than expected third quarter results. Yahoo Finance's Brian Sozzi sat down with the CEO of Dine Brands, John Payton, to discuss the key to its brand's success in the past quarter. Take a listen.
We had a really good quarter. Applebee's had its 7th consecutive same-store sales growth. IHOP had its 6th consecutive same-store sales growth. Average weekly sales for both brands is now equal to or exceeding 2019. And that's because our brands are trusted and well known by our guests. You know, in tough times like this, people flock to brands that they trust. And Applebee's and IHOP are about great value. They always have been, and that's couldn't be more important than it is right now.
There's nothing like taking a bad day at work and just having 8 pancakes, John. I mean, why not? Those multigrain pancakes at IHOP are my jam. But take us through each brand. What are you working on with Applebee's?
So Applebee's is focusing on its core menu, really great marketing innovation. So this summer, for example, they partnered with Top Gun, and they partnered with Fandango. And so for every $25 you spent at Applebee's, you could earn a free ticket to Top Gun. And so